So what types of investments and securities should you be using in your portfolio or in your life in general to grow your money? That's what we're going to be talking about today. Let's get moving forward. Hi everyone, welcome to the Plan Ranger, where our goal is to provide you with informed insights and a reasonable approach for managing your personal finances. So we're going to piggyback a little bit on a video that we did last week about asset allocation, because inevitably the question came from that. Okay, so we've got my asset allocation. I understand that I've got stocks, bonds, and cash, and that breaks down into all these other positions like large value and growth and all this stuff. But what types of securities should I use or investments to fill out those asset classes? Should I use stocks, bonds, mutual funds, ETFs, gold, cryptocurrency, real estate? What is the way to actually fill in those investments so that I actually have an asset allocation, so that I have a portfolio? What types of things should I be using? So today we're going to talk a little bit about that. To get started, one of the things I want to do is just kind of tell you right up front what you should be using, and then kind of go into the reasons for why you shouldn't use possibly other things. So your average person who's just trying to grow their money over time should probably stick to using either mutual funds or ETFs. Now that might be an answer you already know, and maybe you know the reasons why, maybe you don't, but the questions might be, why shouldn't I use some of these other things like stocks and bonds, in particular stocks or real estate, things like that you tend to see more in the headlines, that tend to be more on the surface of information, right? More so than a particular ETF or a particular mutual fund that, they're just not quite as glamorous, let's just say. You should probably start, let's talk about here, the basic core person should probably be using ETFs or mutual funds, which are basically a basket of securities that are usually managed by a fund manager or a mutual fund manager or an investment manager. Maybe it's active, maybe it's passive. We won't get into that right now, but just know that what you're going to do is when you buy one share of a mutual fund or an ETF, that one share is spreading your money out far and wide. Instead of just buying one share of Tesla, let's say, or General Motors or Apple computers, when you buy a mutual fund or an ETF, that money is getting sprinkled out across a basket of securities. So right off the bat, you're getting diversification. You're reducing from the equation what's called unsystematic risk. We won't get into the weeds on that. That's going to be covered in another topic on diversification itself. But just know that by doing that, you're removing the risk that, let's say, the CEO is drunk on the job all day, or something like that, or just using all the corporate money for office parties that everyone loves, so that everyone will love them, right? So maybe that's what you're avoiding there, just by spreading that money out. The next thing is, you're avoiding by using mutual funds and ETFs and handing that responsibility off, you're removing that amount of due diligence and that legwork that you have to do to properly understand what's going on inside of that individual company. If you're holding one stock, you'd better really know what's in there. If you're putting, the proverbial all your eggs in one basket, you'd better know that basket is really sound. And so by handing that money off to a mutual fund mutual fund manager, an investment company that's going to, like BlackRock or American Funds or, Franklin Templeton, whoever, you're going to have somebody there who's kind of taking that burden off of your shoulders, that knows what they're doing, and this is what they do all day long. I will kind of say real quick here that if you wanted to have stocks, if you find that interesting or compelling, and you wanted to do that for the fun of it, you can set up, and I encourage my own clients to set up a gambling account. Account that has 3, 4, 5,000, depending, again, we're skipping past all the steps here, making sure your emergency fund is already set up first, and, making sure that you're checking all the fundamental boxes should happen first here, budgeting, yada, yada. But once you have all those things checked, if you wanted to set up a gambling account just to, be in there trading, having some fun, tracking this stock, tracking that stock, that's great. You're going to learn more. You're going to be more engaged about the market. And then you're going to understand better why, when you really start walking that road, you're going to have a better understanding of why you should have better diversification, why you should probably be using ETFs and mutual funds as opposed to individual stocks or, something like that. Ironically, if you want to use individual securities to really grow and invest your money, your average person, your average investor, the area they could probably get away with that would be to use individual bonds. just because there's more of an implicit guarantee there, even though there's no guarantee, there's more of a set contract and reduced risk of things going wrong versus stocks. Worst case scenario, if you buy individual bonds, you just ride them out to maturity. The bigger risk there is that, they default, but that's really not that common with bonds. So anyways, if you want to use individual securities, you could. Ironically, that's the thing that nobody ever talks about because, again, bonds are not glamorous. They have no sex appeal like stocks do, right? Hey, Tesla stock which is great, don't get me wrong, but it's just maybe not what you should have in your portfolio. Your average person who's at the core, the center of a bell curve, let's just say, for most of their money, the vanilla, the central approach is to use mutual funds and ETFs. Things like, and in the same realm of picking an individual stock, would kind of fall real estate too in this aspect, because real estate is very capital intensive. You're either going to put in a lot of your own money, generally speaking, a lot of your own time, or use a lot of leverage in order to really do real estate investing well. And even then, you're probably buying one house or one multifamily unit or one commercial real estate, one commercial property. Unless you have tons of capital, which if you're watching this video, I'm guessing you're probably not, have $5 million that you can go out there and invest. Real estate investing really involves a one-shot type of deal, a lot like buying one stock. You're putting all your eggs in one basket, regardless of if there's multiple families or multiple tenants or whatever, you're still in one geographic region exposed to a lot of the similar risks. So one stock could be a lot like, in the same aspect, real estate investing. So in that aspect, real estate investing, I don't think should be the core of how you're trying to grow your money necessarily, but that's just me. And keep in mind, my background is more from the security side of things than it is real estate. So along with that, when it comes to real estate, should your home be a primary investment vehicle? I don't think so. I'll tell you a story real quick just to make this point. Years and years and years ago, when I was just getting started in business, I had a meeting with a gentleman, a husband and wife. We show up to their house. I was tagged along on this trip with another advisor. He had the relationship, but he knew that I knew more about, finance in general, so he brought me along. Anyways, we go there, we show up. This house is $1 million plus house. It was gorgeous. Marble foyer, magnificent staircase, everything you'd picture when you picture $1 million home, unless you live in Palo Alto or something like that. But in the Midwest, $1 million home goes pretty far. So this beautiful, beautiful, beautiful home. The guy was in his mid-50s and he had literally liquid assets less than $100,000. All of his money, he thought in his head, was in real estate, that he was just gonna, keep rolling it. He kept rolling his balances forward. So every time he could, he would go to a bigger and bigger and bigger home with the idea that someday he was gonna sell that and that was gonna be his nest egg to retire on. The problem there, or the fallacy I would say, is that strategy involves you basically saying, okay, I'm going to go from living way up here in the multi-million dollar lifestyle, like, hey, I make $800,000 a year to afford this type of property, to, okay, now I'm going to take that money, I'm going to move down to a $150,000 to $200,000 house, and now it's, that's a drastic pullback in lifestyle. I'm not sure if your average person, again, that's in the center here, could really handle that well, could take that adjustment well. So I don't know if you're using your home as an investment vehicle is a good way to go either. At least personally, that's not necessarily the way I would approach it. Some people might disagree there, but real estate, maybe not. Gold, cryptocurrency, and all these kind of other, I would call them fringe investments that could be part of your portfolio in some little, pie, maybe 3%, 5%, 6%, maybe. You don't want to bank on those in the center either. And when you buy Bitcoin, again, it's like buying one stock. It's like buying one house, one apartment, whatever. You buy gold, you're buying exposure to one precious metal instead of a basket of commodities that would include things like, and by the way, you can do this through ETFs and mutual funds. You could buy a broad commodities basket, which would include things like pork bellies, orange juice, copper, gold, silver, wheat, any number of things. And sometimes they'll go outside of that into futures contracts and derivatives and this, that, and the other. But, you can buy a broader basket of commodities if you want to now, instead of just buying gold, for example. So let's look at this, though, from kind of a different angle. Let's back into this. what is the purpose of investing? If you're investing, you're trying to grow your money. You're trying to grow your worth over time, right? Now, the question is, how fast do you want to grow? Do you want to grow at a moderate pace, or do you want to grow aggressively? You know, what's the type of rate of return you're expecting to get? And are you planning to beat the market? Let me just take a moment here to say some people can beat the market. It is possible, and invariably some people will. Maybe you will. I just don't think you should plan on it. Study after study and research after research from different sources, Dalbar, Morningstar, whoever, they all kind of come out with the same results, which are that your average investor underperforms their benchmark in the market, not just by a little bit, but by quite a bit most of the time, right? Again, there's some variance there as far as by how much. What none of these studies have ever confirmed or said is that, yeah, it looks like your average retail investor, which is you and me for that matter, we're not institutions here, your average individual retail investor is beating the market by 5%. That's not a thing. So for sure, you shouldn't plan on beating the market. Now, what about getting kind of market returns? In some situations, what that would mean would be getting like the S&P 500. Let's say it averages 10% a year, you getting 10% a year. The quickest and easy and cleanest way to do that would just be to own an index fund, right? Owning an individual stock, you could beat the market, you might track with it, you might underperform it. But if you buy an index fund, you can you pretty closely get that, right? If you just buy it, hold it, yada, yada. So then that begs the question, why take any other strategy? Anything outside of doing the index fund is just going to involve you spending more time thinking about it. And ultimately, what this kind of brings us to is the idea that investing is as big a job as you kind of want it to be. There's some basic fundamental understanding, but you can make the job as big or as small as you want. You can pass the job off to an advisor if you want to, or you can do it all yourself. And if you're going to do it yourself, then you can choose to use individual securities if you want to. You can choose to do real estate, gold, crypto. You can build your own portfolios or whatever. Or you can just buy a risk allocated fund. You can buy like a target risk fund, like a growth fund or an aggressive growth fund or a moderate fund, or sometimes they're called allocation funds or target date funds. In your 401ks or if you have a company sponsored retirement plan, you might see target date funds. Same thing in 529 plans. These are things on autopilot, but they're always going to come into either a mutual fund or an ETF format, generally speaking. There's no single stock out there that's, a 2050 stock. That's not really a thing. So by using mutual funds or ETFs, you can kind of find this center core here. And then if you want to do some fun things on the outside, some side projects and some fringe things, you can do that. But I'm just, for your average normal person, I would say in general, and this is not investment advice intended for any particular individual, yada, yada, yada. But in general, your average person is probably going to be best served by diversifying through mutual funds and ETFs. Okay, so that's all we really have for today. If you have any questions, please feel free to leave them down below in the comments. Click like, subscribe, join the Plan Ranger community. We would love to have you. And if you know anybody that's struggling with how they should be investing, please pass this video along to them. Help us help them. And until our next segment, thank you for taking the time. We hope this helped.